Hello, everybody, and welcome to our Smart Tax School webinar series. My name is Omar Medic, and I am the Product Marketing Manager for TaxWise. Thank you for joining us today. Today's topic will be mastering 1040 returns. Whether you're a first-time filer or simply looking to refresh your knowledge, this session will provide some tips and tricks on how to report financial information on the 1040, standard versus itemized deductions, and practical examples. Keep in mind that we try to host one webinar per month, so please be sure to join us in the future if you find today's session to be informative. During the webinar, you'll be able to submit questions to the team and get those answered live. And with that said, I'm very pleased to introduce our speaker for today, Mr. Ryan Hubbs. He's a solutions architect here at Wolters Kluwer. Ryan has years of experience working in the tax industry, and he will be sharing his insights on how you can master 1040 returns for your clients. So with that, let's get started. Ryan, please take it away.
Okay, hello everybody, and thank you so much for the very kind introduction. Like Omar said, my name is Ryan Hubbs. I'm the one that's giving today's presentation. And I typically host like 8 to 10 of these a year. We kind of stop during busy season, but I try to go through all of the key sections of the tax return that I struggled with when I first graduated and I first started doing taxes. With the exception of this one. This one will be the most basic overview that I give out of all the presentations all year. And this one is just going to focusing on the 1040. And instead of really diving into one specific schedule where we're going to go into a great amount of detail, a great amount of depth, we're really going to kind of touch upon all of the schedules, but in less depth. So we'll look at the Schedule A, we'll look at the Schedule B, C, D, and we will even go and kind of just talk about data entry. I think I have some sample documents that we're going to look at today, and we'll just plug them into the software. Just so you can kind of get an overview. This is a great session for someone that's either new, maybe it's your first or second tax season, or you're thinking about getting into taxes, or if even, if you're on this and you're a little bit more prepared, this will eventually be posted to YouTube. And as you have staff that's new, that's maybe seasonal, this will be a great resource to show them, to kind of help train them and get them up and running. So with that very long introduction out of the way, I am going to go ahead and push it to the next slide here. And I always like to have one slide, just putting a face to the voice and just kind of going through my credentials, just so you know, I should be talking about the things I'm talking about. My name is Ryan Hubbs, like I said, and I do have my background in accounting. It's what I went to college for. It's what my degree is in. And after I graduated, I lived in DC for maybe 9-10 years. And I worked for 2 CPA firms up there. Now, working in DC, you definitely do a little bit of everything. I did some nonprofits, I did some audit work, I did some compliance testing with the government, but most of what I was doing was taxes. Like once busy season rolled around, it was all taxes all day, 80-hour weeks trying to get through just, an enormous amount of returns in a very condensed amount of time. So really going to be my goal today to kind of walk through some of these different areas of the tax return to give a basic understanding. And then as well as that, we will also be kind of jumping into my tax preparation software and trying to give you some live examples of how to prepare these forms and how to prepare these worksheets. So with that out of the way, let's go ahead and talk about today's objectives just to kind of neatly summarize them here. And I think the first place to start is with the very basics. We're going to identify who files a 1040. Now, if you were on this call, you probably file a 1040. Really, any individual that has any income stream whatsoever should file a 1040. Now, some people don't, and that's when we have clients that come in that haven't filed their taxes in 5 years or 7 years or however many years, right? But really, most individuals that are making any sort of money, they're not dependents. They're typically going to be the ones filing a 1040. Now, once we kind of go through the basics, we'll talk about how to report this information. And the 1040 specifically, we'll be using tax preparation software to kind of show you forms and worksheets and what that general workflow, what a day in the life of a tax preparer looks like. And then we'll kind of talk about the standard or itemized deduction. Going when I first started preparing taxes a long time ago, I always thought that the itemized deduction was absolutely better than standard, and you should always take it. In many instances, it is a far superior deduction than the standard, but the standard grows every year. Standard grows at, I would say, at a pretty generous rate. And so, it's not always going to be necessary to do these itemized deductions, with the standard deduction being where it's at, especially for lower income earners. And, we'll kind of talk about that. There is really something to kind of touch upon is it worth your time to fill out the Schedule A? And we'll talk about practically speaking, and then theoretically speaking, is it worth your time? Because it's going to depend on the client in some instances when you know that one's better than the other. We will also be looking at some tools to help us complete the 1040 tax return, specifically like how to clear up diagnostics. What are some tax research tools if we run into things that maybe we're not experts in and we'd like to get a little bit more information. And then kind of the last bullet point is all encompassing. We'll just be using practical 1040 examples. We'll be using TaxWise Online today. I have many different tax softwares, but I'll be using TaxWise Online today. And we'll kind of just run through and, mark up a mock return, more or less. So with that being said, I'm going to go ahead and open it to today's polling question. I do like to know what sort of audience I'm working with. So I have a couple different options here. I'm really just asking, how many tax seasons have you participated in? And then based off of this answer will probably dictate how much detail I go into. If we have a lot of like newer preparers, somewhere between like 0 to 2 years, we keep them more on the basic side. If we do have a lot of people that's 5+ years, 4 years, 3 years, etc., may go into a little bit of depth. But this slide here is really to help let me know what the audience composition is, so I can kind of either enhance or draw back on the level of detail that I'm going to go into. So I believe the polling question has launched. Let me make sure. I may need to click on the next slide here. Let's see. I'm not seeing any answers come in. Hopefully I'm doing this correctly. I'm still getting a little bit acquainted with On24, which is a new platform we use to host these presentations, so I may be doing something wrong. Let me see if there's anything I need to click or do. Okay, I am seeing some answers come in now. And I think the reason I couldn't see it is I could only see the first 3 responses. It looks like about half of you are 5+ years. We got a pretty even mix then between 0 to 2 to 3 to 4, 5 years. Okay, so about 50-50 on the scale here. So I'll try to go into some little nuggets that hopefully more advanced preparers will get some use out of, but it will also make sure to hit on the basics. So jumping into our first practical slide, let us go ahead and talk about identifying who files a 1040. So with who is going to file a 1040, it's like I said earlier, this is going to be a US-based tax form, and pretty much anyone that's on this call probably files a 1040. I file a 1040. Really anyone who's making any sort of income is going to file a 1040, and it's very versatile. I think it's very easy to think about filing this form with someone who works for a company like I do, right? I work for Wolters Kluwer. We own TaxWise. I have a W-2. That's where I'm ultimately reporting my wages, so the government knows, how much I made, how much they're going to take from what I made, what my withholdings were, am I getting a refund, amount due, etc. But you don't necessarily have to have a job to file the 1040. I mean, the government is very all-encompassing with different types of income that they want to know. Yeah, I have just a couple of examples on the screen here. So like interest, if I open up a closed deposit in a bank, even if I'm not working, the IRS wants to know about that. Depending on how much you make, you may have to pay taxes on it, you may not. Investments, think of stocks, crypto, things of that nature. And even welfare. I found this to be interesting when I first got into this, because the government's giving the money. If I'm collecting unemployment checks, the government's giving money, you would think I wouldn't need to report it a second time, but there is a form to go ahead and report these sorts of things. A lot of times there's a divide between states and federal government, so you will have to report these. And it, really the main reason being is that it just kind of paints a more accurate picture of what your total income was throughout the year. Like maybe I was unemployed for part of the year and I got a few unemployment checks, but then I found a job. Well, the government's going to treat all that income, right? When they're figuring out your AGI, then we can figure out how many your taxes are due. They are going to potentially taxing, I should say, on welfare. I'm using the unemployment as an example, which is definitely taxable, but kind of on a case-by-case basis, but they're going to want to know about it. And then some kind of more niche things like gambling winnings. Now, if you go to the casino, I have a friend who gambles all the time. He lives in Vegas, plays poker. He will actually get the documentation from the casinos if he has a big night. So he has to report it on his income taxes. Now, if you're like me and you don't really gamble, maybe a little bit here, a little bit there, I win a couple $100s. You're not going to get that sort of documentation from the casino. So really is going to be focusing more on the large income earners. I think technically you're supposed to report everything, but practically speaking, Really, when you're going to run into that is with like the professional gamblers, right? Typically poker players, but sometimes other games as well. That's when you may really run into that. Now, if they have a small business, we kind of need to talk about this. If they have a small business, there are business returns like the 1065, the 1120S. Those are typically smaller size business returns. But not everyone is incorporated in a way where they're going to have to fill one of those out. A lot of times, small businesses, it's just like a sole prop, one person, never really incorporated how I'd recommend for them to. They're going to fill that information out right on their 1040. So just because it's a business doesn't necessarily mean that it's going to go on a different tax return. Really comes down to how are they incorporated as a corporation? Did they formally set up a partnership? Did they file that paperwork with the government? If so, yes, there will be a different tax return they need to fill out. But if not, if it's a small business, it may just go on the Schedule C. We'll kind of glance over the Schedule C. I have a few presentations actually that are out on the web that if you want to go into more detail with the Schedule C, I spend about an hour going through in great detail every little facet of it, but we'll at least do a little flyby while we're on this. And, a common question and a good way to get you thinking about what the IRS is expecting from us is this common question I have at the bottom. If I find $20 on the ground, am I supposed to report it to the IRS? And answer to that is going to be yes. You're technically supposed to report it to the IRS. The IRS really wants to know about every dollar that you've come in contact with, is how I think of it. And so even if it's just your lucky day, $20 bill, $50 bill, $1 bill, doesn't matter. They typically want to know about it. Now, practically speaking, I think there are some limits to what the IRS is going to know and what people, quite frankly, are going to tell you as their tax preparer, right? They're not going to tell you they found $20. I'd be shocked, as it's not really a significant enough sum to really justify telling everybody about, right? So there are some practical speaking ways, but from a very technical, what the IRS expects standpoint, they want to know about it. And if you find out about it from your clients, you should report it for sure. So just that's a good general mindset to have when you're not quite sure, should I report this? Should I not? The default should always be the IRS wants to know. There may be some exceptions as you go through tax returns where it may be okay not to tell them. But, as a general rule, the IRS wants to know, and that's how you should think about it with your tax returns. Now, to kind of get some practical examples in here, I'm going to go ahead and bump it to what I would assume is the most common type of financial record that we run into. And that is going to be the W-2. Now, if you work for a company, I personally work for a company, anyone who works for a company, as that company pays them a salary or commissions or things of that nature, they're going to get a W-2 at the end of the year. And this is, on the one hand, a pretty straightforward document that's not too difficult to report. But, it's one that you're going to run into time and time and time again. So what I'm going to go ahead and do is let us go, and I need to share my screen here. And I'm going to jump into our tax prep software for just a minute. And I want to share this screen. We're going to share that screen. Then I'm going to go drag my software over, and then let me just make sure. Give me 1 second to rearrange my windows. Just want to make sure I'm sharing the right screen. I believe that I am. So I'm in TaxWise 2024. The 2025 version should be coming out pretty soon, but it's not quite out. So when I go and jump into a tax return, I'm going to go ahead and jump into, we're going to click up above here. I'm going to go ahead and jump into a 1040. Going to go through the W-2 inputs. Now, this return that I'm working on has a lot of information already within it. So I'm going to scroll through my tree here, and somewhere within this tree, here we go, I have a bunch of W-2s. And, it looks like I've pre-filled this one out, but what I'm actually going to do is let's go ahead and add in a mostly blank one. And when we add in a mostly blank one, we come down to this section here. This is going to be really where you're inputting the information. There's really a couple ways to do this within our tax software. It's one, we could go in and type. I think looking at the example I have, they work for the Burger Hut. I would then go and put in the address, which looks like it's 12 Shorter Avenue. It looks like the zip code is 30165. So I'd input that. And it's really a very straightforward process. We're kind of just going through and looking at the documentation as it appears and then just plugging it into the software. And typically, once you get into the wages section, this is where you would start to, really start with the wages, because most tax softwares, whether it's this software or another tax software, it'll start to calculate like the Social Security, the Social Security withholdings, Medicare withholdings, etc. Now the taxes withheld is probably going to vary. A lot of people take a little bit extra out of every paycheck just so they kind of ensure that they're going to either get the refund or maybe they're going to just get slightly less amount due, right? If they're particularly a high income earner. So I'm going to go ahead and put, I don't know, we'll say $3,000 or let me go, $3,000. The software is really calculating. Now you can see within this return, I have a whole bunch of documentation here. They owe an astronomical amount of money. If this is your client, they're probably not going to be too happy with owing over almost $250,000, but this would be your general input. Now, with something like a TaxWise, you could also just scan the documents in. There's this option here called the Vault that if I don't want to go and type in W-2s for my clients over and over and over again, I can go into the Vault. There's an option here to scan the documents. And really, once you go and click Scan Document, we'll add in a new one here. It'll do an OCR text recognition scan, and it'll kind of read the W-2 that we're looking at. You just click Import, and this is going to have slightly different data than the one I just input. It's not for the Burger Hut. I think this is for Westminster Accounting. Yep. And it went and it kind of just auto-filled this data into the fields for me, so I did not have to type it in. So just another option that's available to you, but your W-2s are mostly straightforward. In fact, most of the questions I get with W-2s come once you get down to box 12 and box 14. If they have employer covered, like employer subsidized healthcare, 401ks, things that are outside of the normal wages, this is really where you're going to go in order to input this information, both boxes 12 and 14. You typically put the code in. The code will be listed on the W-2 itself, and then you typically type in the amount. If you needed to go ahead and put in state info, if it's just one state, it'll just all flow through to the states, pretty much matches what's in the federal. But sometimes they work for multiple states, right? They have a little bit of income here, a little bit of income there. That's when you need to go in and add in, I don't know, a second state, give it a state ID number, then start, typing in how to allocate it. You're really just doing it from this worksheet here. So and just kind of jump back to the PowerPoint just so we can see the W-2 once again. It's really this bottom section where you're going to have your state wages, state withholdings, and then up above, if they do have box 12, there could be a few of them, right? It's typically not all reported on one line item. Sometimes there's like healthcare, then there's 401ks and all sorts of things. So like it'll just list them out. It'll usually have a little code and a number. You just kind of type it into the software. And things like your W-2s and your 1099s are really the more straightforward items of preparing the return. These are the items that are kind of the same, regardless of client. Maybe some of the boxes change. Obviously, the amounts are going to change or who it comes from, but it's kind of the same repetitive process time and time again to get these done. They're definitely on the easier side of items within a tax return. Now, when it comes to the 1099s, there's a whole bunch of different 1099s. There's 1099s for interest income. Maybe they're getting dividends from stocks. Maybe they own a small business and they have they're working as a contractor for another company, but they're not an official employee. You could get a 1099 for a lot of different types of income. And some of them none of them are really all that difficult to report, but some of them are more straightforward than others. Like if I have a closed deposit with a bank, I'm going to make some interest. That interest is going to be reported on a 1099 INT. And then it's pretty straightforward. You kind of just do the same sort of input process, when actually preparing the return. But same thing with dividends. So I own a stock and I'm getting dividends as part of my ownership in that stock. You'll get a 1099 dividend, maybe on the brokerage statement. Maybe you'll just get an individual 1099 slip. It kind of depends on who you're using as your brokerage, how you're going to receive this information, but also pretty straightforward. Now, where it can get a little bit confusing is if I push it through to the next slide here, is the 1099 miscellaneous versus the 1099 NEC. And this took me a while to kind of get down when I was first starting out all those years ago, because they seem very similar. They're both reporting income for basically non-contract or contractor work, right? I don't work for the company, but they've hired me to do a large engagement or a large job. And, I'm going to have to pay taxes on whatever they pay me, right? And so there's a couple different ways this could be reported. This could be reported on the 1099 miscellaneous. This was probably more popular when I first got started, and slowly been kind of pushing over to more 1099 NECs. And the biggest, I would say, differentiator between the two of them would be the first bullet point. 1099 miscellaneous is used in reporting of payments that are not subject to the self-employment tax. And the self-employment tax is probably a little bit too in-depth for a more generalized meeting like the one that we're on right now. But more or less, if you have self-employment tax, you're going to be opened up to double taxation. So, you probably would prefer getting an NEC where this is going to be used to report non-employment compensation that is subject to the self-employment tax. So you'd rather get the miscellaneous is not going to be subject to it. The NEC, that's where you get the double taxation. I think I said that backwards as I was going through the slides. Just want to clear that up. Now, a lot of the miscellaneous items, I think the most common one will be like rents. Like you own a particular property, maybe a property manager really doing the work for you. They're cleaning it up. They're finding the tenants. They're accepting the payments, the rent, on a monthly basis from the tenants. They'll typically give you a 1099 miscellaneous. You'll go into the software. We'll kind of look at that in just a second. You go into the software, you fill it out. 1099 NEC, this will be more so on the independent contractor side, which, probably unfortunately we've seen really grow over the past 5 to 10 years, where a lot of companies don't want to hire people as employees because then they're more or less on the hook for the benefits, right? They got to cover most of the healthcare plans. They typically will offer 401ks, things like that, maybe HSAs. And a lot of companies don't want to pay that. So they'll hire a bunch of independent contractors that are more or less kind of acting as employees, but technically they're not. So they can kind of circumvent a lot of that. So that's one of the reasons why you're seeing so many more contractors, kind of develop or grow over the last decade or so. Now, when it comes to filling out either one of these forms, this actually is pretty straightforward. I've probably explained it the most complicated way possible from like a practical standpoint. Practically speaking, if we go into our software, let me see if I have a 1099 in here. Yeah, I have a few 1099 miscellaneouses. So the way that I've set these up, let's go ahead and just click on the first one here. This pretty much matches the documentation, and I need to share my screen. Go and share my screen so we can all see what I'm talking about. That would probably be very, very helpful. Okay, so sharing my screen now. So when I go into the tax software, this is more or less, once again, set up in the same format as the documentation we were just looking at, where we have the payer information, the EIN, if it's a business, if it's coming from an individual, the social security number, the name of who it's going to. We'll go ahead and say this is going to, I believe this is Ryan Edwards, Ryan Andrews, right here. And, pretty straightforward. The name, is coming from the company. We'll say ABC Co. And then down below is the recipient name. And then it'll kind of break down the different types of income. So we might have rent, like the example I was giving, royalties, other income. Occasionally there'll be withholdings that are taken out throughout the year. Now, this will be stated bluntly on the documentation you're receiving from the client. So you'll know if there's withholdings that you need to input here. Will affect their ultimate, are they going to get a refund, or if they have to pay, how much, etc. Then it starts to get into areas that I've honestly never run into. I've never had crop insurance proceeds. I live in an urban area, so not a lot of farms for me to worry about as far as the income presentation. But the point that I'm trying to get across is, here's golden parachute payments. I've never run into these bottom sections, but they're here. Really, the point is that it's very all-encompassing form. It's kind of like if it doesn't fit into the interest, the dividends, the W-2s, the retirement, like any of those like neat, tidy forms, they're probably going to get a miscellaneous. They may get an NEC as well. So it's kind of like the catch-all for anything else that doesn't have a neat place to go ahead and report it. We'll typically go on one of these. Now, the way that I've actually set this miscellaneous up is I've set it up so the income is flowing through into a Schedule C. And this is a common thing that you'll kind of have to be on the lookout for if the client owns a business or if the client owns a rental and it's going to the rental. A lot of times, these 1099 miscellaneouses, you ultimately want them to flow through to somewhere else in the return. So you're not like typing the information in over and over again, because it could lead to mistakes, could lead to definitely more time to prepare the return. So I have an option here to change the parent form. It's these little arrows that are kind of crossing and intersecting. So Right now, I have this set up to go to the Schedule C, but if I were to click the change the parent form, I could go, maybe it needs to go to a Schedule E or somewhere else. I could also type it into this field, but a lot of times these things will be associated with another entity within the tax return. And really, when it comes to the word entity, you have the individual, obviously that's the main entity, but if they own a business, it's best to think of that as a separate entity. Even though it's their business, they're going to pay taxes, it's flowing through to their 1040. A lot of times you want the income streams to appropriately go to where it was earned, because business is going to be taxed kind of differently than like their wages, for example. So you want to keep everything allocated and flowing properly throughout the return. Okay, so jumping back into the PowerPoint here, let me stop sharing my screen. This should now be sharing the PowerPoint. Okay, let's kind of briefly go over a couple of these different areas within the tax return that are common. We have Schedule A, Schedule B, Schedule C, Schedule D. So the way that this is going to be arranged within tax software is typically, doesn't matter what software you're using. These are all separate schedules that will be filled out kind of, as you go through the return. So Schedule A is for your itemized deductions. We're going to talk about itemized deductions in a bit more detail in just a second. So I'm going to kind of skip over it and go out of order here. We're going to start off with the Schedule B, the interest and dividend income. Now, depending on your tax software, you will input this information a couple different ways, or really there's a couple different ways to do it. One is that some tax softwares will have forms like we've been looking at with the miscellaneous and the W-2, where you kind of just look at the documentation and then you fill out something that's more or less a blank representation of that, and then it flows to the Schedule B for you without really having to do anything else. So something like the tax software I'm using today, you actually just kind of fill out the Schedule B as you go. So if I go and share my screen once again, share screen 2, we jump back into TaxWise. Let's see if I have a Schedule B in here. I do. I have a blank one. This is not a valid parent form. Okay, so with the Schedule B, it'll break down things by orders, different segments, right? So I have seller finance, mortgages. More commonly, you're going to come to the other interest section. And I would just say, they had a Wells Fargo 1099. They had $1,000 of interest. Then they had one from the credit union. It could be any credit union, right? We go ahead, we input it, and they had $3,000 in a CD there. This is kind of the input process within something like a TaxWise. If we go to the dividends, probably say, okay, they had a Robinhood account, or maybe you want to put the exact. So let's talk about this. So you can put in do a summary. I could say, okay, they had a Robinhood. They had a total of, $452, or you could break it down by individual investments. They owned Microsoft. I don't know if they actually give dividends or not, but we'll just say they do. And they had $2,000. This will be the input process. So, there's not a ton of information typically with the dividends. It's usually straightforward. Sometimes, especially if it's like foreign income, you might start to get a little bit more complicated. And that's really when you'll come to these sections down below here. You can see there's a lot of foreign income questions. And typically you'll get this if they own a foreign company, right? If they own a foreign company, they own a country that's incorporated overseas, but maybe that company's doing business in America, or they really don't even have to be doing business in America. Just to be own part of the foreign company and going through a foreign stock exchange, that's when it's going to be taxed a little bit differently. IRS is going to want to know a little bit more information. For anything domestic, it's usually pretty straightforward. Now, next item on the list to talk about would be the Schedule C. The Schedule C is for the businesses. And like I said, I've done 3 or 4 different presentations on the Schedule C over the years. So there are resources out on our YouTube page that will really dive into this in great detail. So this is going to be more of a flyby generalized overview. But with something like the Schedule D, Schedule C, first few items are going to be the basics, like what's the name of the business, maybe the business code, what are they selling, what are they building, how are they making their money? That's really this first item here. Then want to know the address, zip, etc. And then it's going to get into the accounting method. Now, this can kind of trip you up if you haven't really done a lot with the different accounting methods. The 2 biggest ones here are going to be the 2 that are listed, cash and accrual. And I think all you need to know about the difference for a basic overview like this is when is income and expenses being reported. For the accrual method, which I would say is it's more common. It's when the expenses are incurred. So if I go and let me give an example. I run a business, I have an office, I hire a contractor to fix the ceiling in the office. There's a problem. And they need to come in, they need to fix the drop tiles, whatever. As soon as they've gone and fixed it, I would owe the expense on my tax return. It does not matter if I've paid them or not. It's just that if they've done the work, I owe them the money. As soon as I owe them that money, that information gets reported on the tax return. The cash method is different. It's actually a little bit easier maybe to track because you're really just following the cash streams. Like even if that contractor goes in, changes it, but maybe they've given me an invoice, I'm not paying it immediately. I'm paying it, a month from now or whenever, 2 weeks from now. I would report the expense when I have paid for it. That is the simplest way to break down the two. But the thing that you need to know is you need to stay consistent. Within their business, you cannot mix the cash and the accrual method. If they're using accrual, it's always when the expense has been incurred. If you're using cash, it's always when the expense has been paid. And same sort of inverse concept for when they're receiving, revenue as well. If they've gone and they've provided a service and they're using the cash method and they haven't been, compensated, they haven't been paid yet, they wouldn't report that. Whereas if they're using accrual, well, they've gone the service. It's reasonable to assume that, they're going to get paid for it since they've gone and prepared, they've done the work, right? So, as soon as they go and complete the job, you would report that as income on their tax return. That is the most basic way to explain the differences. I'm not going to get into some industries have some like specialized accounting methods that they can use. It's a little bit too advanced for a presentation like this. But really, once you scroll down, you're going to get into where you'll spend more time, right? You'll spend more time on income and particularly probably expenses. So to give a flyby of this, income is probably a little bit easier to go over as you'll have your receipts, your sales. You can have a little bit of an allowance for returns that you think are likely to happen, right? You can kind of write that off, but if they don't happen, you'll have to pay those taxes later. Income's kind of straightforward. Like I said, you can see 1099 miscellaneous here. A lot of times you'll fill out a 1099 miscellaneous. It'll fill into this field for you based off your inputs. So, everything's kind of communicating with one another. But when you'll get into the expenses section, I would say the majority of the expenses are straightforward. The client will kind of tell you what the expenses were, whether that's in a QuickBooks file, maybe a trial balance, maybe notes on a piece of paper, depending on the client, right? So then you'll just type in most of these, but occasionally we'll need additional information. A good example would be car and truck expense, right? We need more than, how do we come up with this number? Like there's a calculation that has to occur to figure out how much you can ultimately deduct, right? So we need more. It's not just a number. We need to know a few things. So if I go and open up the worksheet for the vehicle expenses, well, now it's going to ask me that additional information. I need to put in the business miles, I need to put in the total miles, then go and plug in the expenses that they've incurred throughout the year. And then it kind of does the math, takes the total, figures out the percentage that's allowable based off these two metrics. And then it does figures out the deduction. Could also take the mileage method as well. But even if we're taking the mileage method, right, we still got to plug in how many miles they drove throughout the year. So there's still a calculation that's going to occur. That would also affect their depreciation. So, the software is really doing a lot of the heavy lifting for us, kind of in the background. And we use these worksheets to really give the tax preparation tools that we have the knowledge that it needs in order to calculate these tax returns. And, this is really how you're going to run through a Schedule C. You kind of type in some of the more basic expenses. Oh, if I have repairs and maintenance, you may break it down into greater detail. It may just be a line item they give you. It's kind of dependent on the client. But this will be your input processing. You'll kind of work through. And if you need to attach, 1099s, like I said, you can kind of attach it so it all flows back to this revenue section here within the Schedule C. But this will be used for the small businesses. And, whether they file a Schedule C or if they need to file a more formal like 1065 or 1120S, is really going to depend on how they set up their business. Now, just to give a brief aside, I try to get all my clients set up as usually 1120S corporations, as if they make a dramatic, massive mistake and they get sued or they have a terrible business and it's not profitable, they want to be personally liable for any damages that are incurred, any punitive damages, any losses, debts that they may incur with the business. So I view it as extremely risky to have them be sole props that are filling out this form here. I highly recommend against it. But, some clients take our advice, some clients don't. We can only give them the advice and then it's up to them to, either listen to it or not. So I would always push them to become an S corp, and then just fill out the 1120S, have the income flow through on the K1, right? But if they're just a sole prop, they're going to fill this out. So it's just really how they incorporate it. To become an S corp, it's really not that hard. Many of you probably are S corps, since you most likely own a business if you're on today's presentation. But if you're not, and you're not filling out the 1120S, I would recommend it for you as well, because if you make a mistake and you get sued by the client, you don't want your house, your car, your personal assets to be on the hook, right? So I do have a presentation about that also on YouTube. Definitely check it out if it's something that you think you get some value out of. Now, going into the last of the schedules, and let's see how I'm looking on time here. I'm about 40 minutes in. Okay, so going into the last of the schedules, this will be the Schedule D, capital gains and losses. Now, this is where you're going to report the stock transactions, crypto transactions, long-term, short-term transactions that have occurred throughout the year. And with this, really the main breakdown the IRS is going to want, it's going to say box A, box B, box C. If we scroll down a bit, we have box D, box E, box F. The big two ones here are box A and box D. These will be the two most common ones. And with these different boxes, these are the items that where you're going to really report that is it a short-term gain or loss. If it's short-term, it's going to go in box A. Short-term is just assets that they hold for less than a year. I think the easiest way to visualize this is think of a day trader that's going crazy, selling, buying stocks, and then 20 minutes later selling stocks. All those sorts of transactions are going to go on the box A, the short-term gain or losses. If you're more like me, if you're a buy and hold kind of guy, and you like to just accrue the assets slowly over time, but occasionally you sell them, but maybe you've owned them for a few years, many years, however many years, anything more than a year, those go in box D. And, when you're looking at the documentation you receive from the brokerage statements, it'll break it down. It'll say, here's your short term, here's your long term. Now, fortunately, the IRS allows summary numbers. So like, let's say they have a Robinhood account. Well, you can just say this is all their short-term gain or losses for box A. Then you come in here, you type in all the long-term gain or losses. Let's go ahead and type them in. So they doubled their money. And you can do the summaries. Then you would then just go and attach the brokerage statement to the tax return, and the IRS will receive a copy. They can review it if they want. Other people will go through and they will type in each and every individual transaction that has occurred throughout the year. You are more than welcome to do so, but it is a ton of extra work. Where you would say, okay, they sold Microsoft. You'd literally come here and say, okay, they sold Microsoft. Oops, I'd have to wait one more time. Excuse me. Let me go back. There we go. Capital gains losses worksheet, this one here. So you would go and fill this out right here and say, okay, they had Microsoft stock. This is the date they bought it. Then you put into the date sold. Then you put in the amount they sold it for, the cost basis. Then you do it for the next thing. Then they went and sold Costco. They went and sold. Like, you could go line by line if you want, but there's really no reason to do so, in my opinion. It's much easier to just go back to the schedule itself. Where is it? Where's Schedule D? Schedule D right here. And just type in the summaries, attach the PDF. You'll get through the return dramatically quicker. If you do it that way, and it's all IRS compliant, so I always recommend doing it in this format. Last schedule to talk about is the Schedule E. We're going to do the most basic overview of the Schedule E. Really, the Schedule E could report a couple things. Typically, rentals could also be for K1 income, or it could also be for royalties. Rentals are probably, K1s and rentals are probably the most common areas. I'm going to talk about rentals today. Excuse me, it's pretty straightforward. You put in the rents they received. Typically, you're not getting rents and royalties in the same column. That would be exceedingly rare. Typically it's just going to be one or the other, most likely rents, and then you'll put in the expenses that were incurred throughout the year to kind of come up with the total number of how much it costs to run that rental property. And then the software plugs, chugs, does the work for you, adds it to the AGI. Maybe it's a loss. And it's a pretty straightforward form. There's not a ton to it. Other place with the Schedule E that's common is the K1s. Now, going back to when I was talking about 1120Ss and partnerships, if they set up their businesses in that manner, that's when they're going to go ahead and have a K1. And the K1 is really where you're reporting the income from those businesses. Businesses don't really pay the taxes, the income, the expenses all flows through to their personal 1040. Then you would just input the information. This will be set up in the same format, more or less, as the K1, and you just look at the K1 and plug it in. K1s are definitely a little bit too advanced for a presentation like this, so not going to go into too much detail. Once again, I've said it a few times. If you go to our YouTube page, I've recorded like hundreds of videos that you could go and see, and definitely have one that focuses on the K1 on both the business and the personal side. So if you have questions about the K1, that is the resource that I would use. Okay, so now getting back into PowerPoint, now that we've gone over the more common forms, we'll come back to Schedule A here in just a second. Do you want to open it up to the next polling question? The next polling question is going to be, are you allowed to file tax returns with estimated income values? This is a question that I run into quite frequently when talking with different clients, and it doesn't seem to be a general consensus, but I have gone ahead and looked this up. So I do know the answer to this, but let's say you have a client, they haven't done their tax returns for like 5 years. You're filling out like the 2018 return, right? And you don't really have the documentation. They've lost it. They're unorganized. What do you do in that situation? Is the IRS going to allow you to use reasonable estimates, or are you really going to have to go in and dive into and get very specific, detailed numbers and reach out to prior, financial institutions? Are they going to have to go down that rabbit hole of getting everything? And the IRS is very all-encompassing. So, I think this is a good question to ask, as the answer is not too obvious as to what the answer is. So give everybody just a minute or so. I'm going to take a moment to take a sip of coffee here. Okay. And coming back, it looks like the majority of you have answered it. And the answer to this is yes, with a caveat. You can use estimates because sometimes you just can't recreate the data. Give you a good example. I had a friend named Danny the plumber. Danny owned a plumbing business. And Danny had one credit card for everything, his personal expenses, primarily going to the bar, and also for his plumbing business. And everything was a conglomerated mess. You can never really tell what was what within it. And I don't know the last time Danny filled out a tax return. It could have been more than 7 years for all I know. It's been a long time since he has filled out a tax return. He believes that if he doesn't make enough money, he doesn't need to fill out a tax return, which is not true. But either way, he won't do it. And if I were to go and try to do Danny's tax return from 2015, that's 10 years ago. There is no way I could accurately report his taxes from 10 years ago. And the way the IRS views this is like, okay, well, some information is better than no information, right? Because he probably does owe money on it. So if you can recreate a reasonable estimate, and there's a few ways, that word reasonable is very, how do I put it? It's very flexible. It's a very flexible word. If you can go and look at prior year returns and, make an estimate based off revenue, maybe increase the expenses, decrease the expenses based off of, did the revenue go up? Did the revenue go down? There's a million ways to kind of make reasonable. Reasonable is subjective, but you can go, but now you do need to mark it to the IRS as an estimate. You need to tell them like, hey, this revenue is an estimate. These expenses are estimate. They need to know that because they may have follow-up questions if they get audited, particularly, with the tax return that you're submitting. But, as long as you can say, like, this is, I did my best here. Like, I don't have a ton of information. Ultimately, Danny the plumber or whoever's tax return it is the one responsible for giving you accurate information. So, as long as you haven't done anything negligent and you've kind of done your best, and you can really stand by how you're forming these estimates, you should be covered. I mean, it's a very flexible word, as I said. So yes, you can do your best though to try to figure out a reasonable estimation of what they should owe, what they should pay, what the expenses were, what the revenue was, and the IRS will allow this. Now, moving this to the next area here, let me see. I'm actually going to skip past that polling question. We talked about the 1099s. We may have gone a little out of order here. What is this here? Just did that. Okay, let's go ahead and talk about one more thing here today, and I'm going to see if there's any questions that I can answer for anybody. So is it better to take the standard or itemized deduction? This is also going to be Should be a polling question, although I don't see the poll here on my left. Run it. Okay, so instead of opening this up to a polling question, and we're running a little short on time anyways, I'll just go ahead and run through the answer to this. So with this, the standard deduction. Standard deduction is dependent on a few things. It's dependent on what their filing status is. Are they single? Are they married? And it's dependent on how many dependents they have, right? So you get the added deduction for each dependent. If you're married filing joint, you'll kind of combine both deductions into one. It's a solid number. May change based off those metrics, but it changes in predictable ways. Itemized deduction is a more comprehensive overview of all the expenses that they could deduct from the IRS. And really with the itemized deductions, that's when you get all the medical expenses that have occurred throughout the year and, real estate taxes. Maybe they have a mortgage as opposed to owning their house. Really the bank owns it, right? Then they get to deduct the mortgage interest. It's a very all-encompassing view of their deductions. Now, the standard deduction is always quicker. That's for sure. Standard deduction is quicker. You just kind of say they're married, they have 3 kids, here are the ages, boom, you got your standard deduction for the client. Itemized deduction takes more work. Now, there really isn't a universal answer to which one is going to be better. It really depends. For some clients, the standard deduction is going to be the larger deduction, and for others, the itemized deduction will be larger. And it's just dependent because it's not as simple as saying, okay, they had $5,000 in medical expenses. That's a $5,000 itemized deduction. No, it is not. It is set up in very Byzantine ways as to there are floors and there are caps and thresholds based off AGI that need to be reached in order for some of these itemized deductions to really kick in and start to deduct what their AGI is going to be. Now, as a practical, rule, speaking about this, the more information the clients give us, the more likely we are going to use the itemized deduction, right? They have everything very neatly organized, and they have their mortgage interest here, and they got all their real estate taxes there, and they're kind of on the same form, and then they have all their medical expenses tallied up, ready to go. Then, there's more and more and more. The itemized deduction will probably be the more likely better deduction, as the itemized deduction can really, if they hit a lot of the key things the IRS requires, the itemized deduction can kind of skyrocket as far as a deduction. It can be an incredible amount, right? Whereas the standard deduction is what it is, right? So, one of the things that you're going to run into with these itemized deductions is eventually when you've done enough tax returns, you're going to kind of know almost immediately, are they going to qualify for the itemized deduction or not? You'll be able to determine it within a couple minutes, more often than not, once you get really proficient with doing the tax returns. However, there is one little thing to caution you with. I had a client once, and it was very obvious that they were going to use the standard deduction. They actually had a lot of these little things, and their records are really neat, but it was like very tiny amounts. Talking like double digits, triple digits in these fields. And it was extremely obvious that they're going to use the standard deduction. I've done a lot of tax returns. I knew that. However, when I went to review her tax return with her, she knew a little bit about taxes, and she knew that all those little medical receipts that she had should have been showing up here. And I didn't fill this out. I didn't fill it out because I knew she wasn't going to need it. And she asked me why I didn't fill it out. I said, well, just kind of looking at your information, it was very obvious that you weren't going to use the Schedule A. The standard deduction was going to be better, so I selected that for you. But it did create the perception with her. She's not happy with me. It did create the perception with her that I did not take my time doing her tax return, that I had just rushed through it, and I did not, go through and check every box to get her the biggest deduction that she could possibly have. And truth be told, I did get her the biggest deduction that she could have, but I created a perception that I was rushing through the tax return. So you do kind of need to know your clients. Even when you get proficient and you kind of know, if they start asking follow-up questions and they think you did a cheap job, or you rushed through it, or you didn't do a good job because you didn't go through the 10,000 doctor visits that they had that year, and input every one of them into these fields and things like that. You can lose business. I definitely lost her as a client. She did not come back next year. And that was a real learning experience for me, that even though you can kind of tell sometimes, it would have taken me 10, 15 minutes to fill this out. And she wouldn't have used it, but it's just a word of caution that sometimes, especially when you have those clients that know a little bit, they may start asking questions, why you didn't do this, why you didn't do that. And if you don't do these things, it does create a perception that you kind of rush through it. So just this, I guess, a real practical life story to kind of caution you all about, skipping over things, especially the Schedule A. It's the easiest one to skip over because you can almost always kind of tell pretty quickly. So just a word of advice, take that for whatever it is. Maybe you found that helpful, maybe not, but I always like to explain that little story as I go through the Schedule A, as it's, no one wants to fill out a Schedule A with all those medical bills that sometimes aren't very much, but it can lead to unforeseen consequences down the road. Okay, so we're about 52 minutes in, so I'm kind of needing to get to the end of this presentation. Let me go ahead here and jump back to my PowerPoints and see if there's anything else to really go through. I think there's one more thing to go through, and then I'm going to open this up to, I'm going to let you all know about a promo code, then I'll open it up to a final polling question. So I want to talk about TaxWise in particular and tools to help you complete a return. Now, really the two big ones here are to get the red out and the diagnostic reports. Now, diagnostic reports, if you have a tax software that's anyway decent, will have a diagnostic report, right? If you're using a tax software that does not have a diagnostic report, I would seriously think about switching to some other tax software. But more or less, as I go through and prepare the return, once I get to the end of the return, tax software should give you a diagnostic report. It should be scanning the tax return. I have a big diagnostic button right here that will bring up any errors or even potential errors that may have occurred throughout this return. And with these potential errors, or errors, some of these are errors, let me kind of break this down. Anything in red is an error. Something is wrong with the return. If I go and try to e-file this return with the IRS, it is basically 100% going to get rejected. Now, eventually, as I go through all these errors, there's a lot within this return. I'll get to warnings. Warnings are things that the software has flagged that it thinks might be errors, but it can't really determine it on its own. It kind of takes the human eye to really make that designation. Do I change this? Do I leave it? This should be a step that you're always doing before e-filing the return. And typically, these errors have to go. These are items that you got to clear up. Now, if you have a good tax software, you can just go. You can just click. It'll bring you right back to the worksheet or the field where you need to go and input the data. You will see that mine are highlighted in red, just kind of letting me know what I've missed. And these red items will really go and work in unison with the tree. My tree on the left-hand side also, at a glance, lets me know what am I missing from this return. In any of these areas that have the green check mark, I'm not missing anything the IRS requires. It's still incumbent upon me to type in the information right, but I can tell off the bat, like I'm missing something critical that's listed on the 1040. Like that's definitely going to get the return rejected. I need to go ahead and add in a description for this other income. It's all kind of flagged for me within the system. And so my review process typically revolves around going to these items with red exclamation points, finding the red items, cleaning them up. I will then run the diagnostic report for any more in-depth complicated errors. I will click on the diagnostics. It'll bring me back to the data input worksheets. That is my review process. And it's always good to have your tax software be able to kind of give you a report of these items in order to ensure that you are not missing anything. So with all that being said, this is going to be everything that I have pre-planned to go over today. I do want to let you all know about a promo code that we are running for anyone that's like new and they're thinking about getting into doing taxes, or maybe you're looking to switch your tax software. We are currently running a 25% off promo code where if you purchase TaxWise Online through our website, which I have the website listed right down here at the bottom, but if you Google Wolters Kluwer TaxWise, you'll definitely find it. If you input this promo code, you will get a 25% off, which is about the biggest discount we ever offer. So if you want, take a screenshot of this slide here so you can go ahead and, have it available for your reference. It will save you, depending on how many returns you're doing, it could save you almost $1,000. So very good promo code. I'm going to come back to this in just a second, but before we continue, or really come back to this and end this, I do want to open up to our final polling question. It's just like, would you like a more in-depth product demo of TaxWise? In my role here, I do a little bit of what we're doing right now, which is learning and creating resources for the industry as a whole. But mostly what I'm doing is in-depth product demos for people that may want some product with us. That's really where I spend the majority of my time. So if you would like to meet with me about any of our tax tools, whether it's software, whether it's tools to automate the data input, admin side of things, whatever, I can typically do demos, or I have other colleagues as well that can do demonstrations. If it's something you're interested in. Now, if it's not something you're interested in, feel no pressure to click yes here, because if you click yes, we will reach out to you. If it's not something you're interested in, you just came here to learn today, that's okay as well. We just kind of want to give everyone the option that if they do want to learn about the tools that we have, that we are available to go more in depth and give very specific demos. If you have one particular thing your software is not doing, we can give you a demo on how to do it within TaxWise or any of our other products. So with all of that being said, looks like I got about 3 more minutes here, and then I have another meeting that I have to hop on to. I'm going to go ahead and jump this back to the promo slide for anyone that's interested in purchasing TaxWise. But I will be going on mute. I'll be getting set up for my next meeting. And then at the top of the hour, in 2 to 3 minutes, I will go ahead and end this presentation. So I want to thank everybody for attending today. And if you found this information helpful and useful, typically do 8 to 10 of these a year. We'll do one next month, maybe one in January, and then we'll probably take a few months off for busy season. But be on the lookout for more presentations as well. So with all that being said, I'm going to push it back to our last slide here. I'm going to go ahead and end this presentation in about a minute or so. And once again, thank you so much for attending, and I wish you all the best of luck during busy season.